The other news item that we're going to be talking about shortly with our market analysts is going to be the PCE numbers. We have been looking out for them, and this is the Fed's preferred measure of inflation. We are expecting it to come in at 0.4%. This is month on month. And also, the reason one of the analysts is looking out for it is that even if we do see an increase in this measure, that could affect any of the outlooks that we have as it relates to the Fed cuts or expectations relating to that. And that's one of the conversations that we're going to be in discussion with our market analysts shortly. But looking at other local news, we saw FirstRand posting a 6% rise in first half earnings. And this was driven by top line growth, particularly in net interest income. FirstRand is the country's largest lender by market value, and they announced an interim dividend of 200 cents per share for the reporting period, which saw an increase of 6% from a year earlier. Meanwhile, Impala Platinum may consider closing some loss-making mining shafts in South Africa if metal prices deteriorate further and efforts to restructure some operations don't improve its margins. The Johannesburg-based Platinum Group metals producer scrapped an interim dividend and postponed spending on various projects to save about 10 billion rand following a 78% slump in half-year profit. To talk to us a little bit more about the numbers, we are joined by Ricardo Smith, who is the Chief Investment Officer at ABSA Investments. Ricardo, thank you so much for your time. We've seen a slew of company results this morning, so I can imagine you were quite busy. But take me through one or two of the earnings that stood out for you and why.
Afternoon. Yeah, I know for sure. So seeing, FirstRand, I think that's one of the ones that stood out. Are growing, their earnings and their dividends by about 6%, mostly from net interest income. Seeing their return on equity, however, slightly dipping by 1 percentage point, but still very healthy at about 20%. And seeing, their credit loss ratio increasing by about 9 percentage points to 83%. And so that's, starting to speak to some of the pressures from an impairment perspective and a consumer debt servicing cost perspective. The share is up today and, is recovering some of the losses that we've seen, particularly during the course of the month. And, looking ahead, we are starting to hope for a bit of a, turnaround for the finance sector, well, at least in the next couple of months, if we do start to see those rates coming down.
If you had to look back at this month, I mean, we still got a few hours of trading left, but how would you say, stocks performed for the month of February?
It's been, mostly red. So overall, the JSE all share is down, low single-digit returns. But the main driver of that has been resources. We've seen some pressure from commodity prices, and we've seen some pressure from the earnings, and we've seen a lot of talks around, job losses in the sector, and the resource sector typically, at the moment down a high single-digit returns, and down for the year, double-digit returns. So it's been a bit of a bad month for markets, but in particular resources. But we have seen some counters rally, and one of those counters, that we've seen do quite well is Richmond. It is recovering from the last 6 months of last year. And although commodity prices are under pressure, seeing the retail sector and tourism sector in China, expected to do well and recover. And so, participating off of that. So mixed, but overall red.
When it comes to central bank rate cuts, where are you in the debate, and what's your base case when it comes to the Fed's cuts? Looking at the latest dot plot, there's certainly a bit more alignment in terms of what markets are pricing in the US Fed. Coming in, the markets did seem a bit aggressive, expecting cuts in Q1. Looking at Bloomberg consensus, there is an expectation of rate cuts as early as Q2. That may very well, be likely, particularly given the latest dot plot, seeing about 100 basis points worth of rate cuts. And if the Fed is likely to take a more gradual approach, then you would expect them to start cutting a bit sooner than later.
Inflation, although cooling, is still above their target, and so that is one big deterrent from cutting rates, and the fear of resurging inflation. And then locally, we are expecting rate cuts around Q3, but we may see some earlier rate cuts in Q2, but the base case that we have at the moment for locally is in the third quarter.
Speaking of locally, over the next few days, we're going to have some of the JSE-listed companies release their earnings, the likes of Shoprite, the likes of Kuro. But apart from that, if you had to look at overall South African results season, what are you expecting in terms of corporate profits?
So we're expecting anemic growth overall, but we are expecting it to be a bit mixed. We think, the finance sector, would have struggled, from rising impairments and high elevated interest rates. Although we may see a turning point of that over the next couple of months, we expect the resource sector to continue struggling a bit, especially with the commodity prices under pressure. And we think perhaps industrials might be what brings the aggregate number a bit to a positive.
Do you expect central banks to still be a main factor for markets going forward?
Certainly, I think it's very rare to see markets rally in the middle of a recession, and that soft lending versus hard lending narrative is highly dependent on when the central banks start cutting rates. Although what we have seen is earnings releases and earnings results kind of countering what's happening in the macro picture from an interest rate perspective. So if those two start syncing up, then certainly we would expect quite a bit of positive reaction from markets.
Speaking of that, let's take things stateside for a bit and look at, how you're viewing the U.S. markets. Do you at some point see corporate fundamentals and economic fundamentals supporting more gains to come, or are you worried about this rally that we've been seeing?
I think, one of the biggest concerns of the rally is that it has been a bit concentrated to a few of the counters. Looking at the top holdings, say top 10 shares or even top 5 shares in the US, they've typically, driven around half of the returns that we've seen. Of course, they've had some strong earnings results, but, the fear there is that once you get this concentration and money flowing into a few individual counters, you do tend to find that they do get overvalued, they do get overtraded, and other opportunities get missed, and you tend to see some profit taking and some pullback. But long term, we are still, liking a lot of the counters there, and the overall market. We think there's a lot of opportunities that are untapped. So, just thinking of one, the rallies in Nvidia, we've already seen companies like Micron, updating, some of their chip manufacturing that will feed into Nvidia, and we've seen, other players along the value chain like KLM, which specialize in packaging and distributing, semiconductors. And so there's a lot more opportunities outside of the 5 long term. But in the short term, we are concerned that there could be a bit of profit taking in that market. Participation at the moment is quite concentrated.
As we wrap up, when you're sitting with the team every morning, what's the one question that you guys are asking yourselves when it comes to the equity market?
The biggest thing, is are we going to get a recession? Are we not going to get a recession? And, how are valuations stacking up against that? And, is this the time to go longer duration or remain a bit defensive? And I think, those, the answer to those questions will really determine, how markets play out this year.
Ricardo, thank you so much for your time. That is Ricardo Smith, who is the Chief Investment Officer at Absa Investments.